But there's an important component that is left out of this formula, and that component is your investment income and gains. Okay? The insurance company takes money in, premiums. What do they do with it? Well, they invest it to the best of their ability, because typically what happens is they break even on their underwriting, and where they make their money is on the investments. Okay, and that's what you see in this next chart. Lots of zigs and zags over the years where losses and premiums did not match up. And so you can see how often is the combined ratio actually below 100. That's where they're making money on their underwriting. So when you look at it, insurance is kind of a loss leader for these companies. Insurance is what gets the money through the door, but they're not making profits, particularly property casualty companies, on the insurance. They're making money on the float, on the money that they have to invest. And so you can see, more often than not, that line is above 1, where they're losing on the insurance side, okay? But you can see how it moves around, where they're making money, they're losing money, they're making money, they're losing money. And that depends on how accurate their forecasts are for losses. Because then based on their forecasts, they set their premiums. So what really moves this isn't the premiums, it's the claims that are paid, the losses. Okay, and I've got a friend who lives on a boat, and he told me that the year before a major hurricane hit, his insurance cost on the boat was $1,200, and after it was $4,000. His boat wasn't affected by it. Okay, it wasn't damaged by the hurricane, but this new information was factored in the frequency of having a hurricane come in, and then the losses associated with the hurricane, and they said, man, we've been undercharging. And you know, if there are 2 or 3 or 4 years afterward where the premiums are high, okay, and they don't have many hurricanes, then the cost will probably drift back down. Okay, we've had a ton of hurricanes so far. We've got another one coming through, and I think 2 more behind it. All right. So they make their money. They make their money on investments. First time I saw that, I thought that was fascinating. I thought insurance companies were in the business of making money on their insurance, but that rarely happens. You better have good investments, people. All right. So let's look at this term capacity. Okay. So surplus is the difference between assets and liabilities. It's contributed capital and retained earnings. Similar to banks, well, really similar to any company, but primarily to companies in the financial industry, the amount of contributed capital and retained earnings that you have on hand will determine your ability to take risk. Okay? And so your surplus will follow the underwriting cycle. Okay? And so if you have profitable years, then your surplus grows. And if your surplus grows, then you will lower your underwriting standards to take on more risk, and your premiums will decline. Your rates will drop. Your overall premiums will rise, but your rate that you charge for the loss will go down, and your market share will go up. And vice versa. If you have losses, then your underwriting standards, you have lower surplus, less surplus. So you will be forced to take less risk. You can't afford it. And your premiums will rise. The premiums that you charge customers. Okay? What is a clash loss? It's when several lines of insurance are hit at the same time. So 9/11 was a clash loss, and Hurricane Katrina was a clash loss. So several types of losses happened simultaneously. Okay? And so if you're a diversified company in a lot of different businesses in one geographic area, it could really hurt you. All right. So again, if you're looking at investments, it's a really important thing for an insurance company, and lots of investment jobs at insurance companies. And it used to be that insurance companies, the investment jobs were really focused on investing the insurance company's money. But if you have noticed, Northwestern Mutual has really turned into an investment firm more so than an insurance company. They talk about wealth management all the time, much more like an investment firm. And that's where they spent so much time focused on investing for the company that they decided to offer their expertise to the public. All right, so making investment returns flows into your ability to be flexible with your premiums. If you're as good as the next guy in forecasting losses, but you're better than the next guy with your investment returns, then that gives you a lot of flexibility to set lower premium rates and to gain market share and bring more money in. All right, consolidation has been going on for 30 years in the investment industry. It's really, and in the insurance industry. And it's really different. Somebody was asking me to compare consolidation in the banking industry with consolidation in the insurance and investment industry. And they're very, very different. Because when a investment firm or an insurance company buys another insurance company, or an investment firm buys another investment firm, then the firm that is bought disappears forever. Okay? But that's not the case in banking. What happens in banking is when a regional firm comes in and buys a local firm, slowly that local firm is integrated into the regional firm, and the local presence of that bank disappears, it dwindles. It's no longer a local community bank. Okay, and we've seen that in Cersei in a huge way with Regions. Everything, all the decision making at Regions has been moved to Birmingham. We used to have a bank president, and if you wanted a loan, you went to see him. And he knew you, and he knew your business, and a handshake was a pretty good way to get a loan. Not anymore at all. So what happens is, the local bank gets bought, and then after a while, local people see an opportunity and they start another local bank. And then 5 or 10 years later, that bank gets bought by a regional company. And the process starts all over again. But that's not the case with insurance companies and investment companies. When an insurance company or investment company is bought, it's gone forever. All right. So consolidation refers to the combining of businesses through acquisitions or mergers. and two types of combinations. Okay, the two types of strategies. All right, one is both companies are in the same business. Okay? And because of this, you have fewer companies in the industry, and each company that is left is larger. So you're talking about what's called industry structure. Okay? What does the industry look like? And with this kind of consolidation, you're talking about a handful of mega companies. Okay? All right. There's a lot more in a future chapter about brokerages, but a brokerage firm, an insurance broker, represents the buyer of insurance. An insurance agent represents the seller of insurance. All right. Last slide. All right, the other type of consolidation is firms that combine and they're in different businesses. Okay? We talked about this in investments. So you get commercial banks, insurance companies, and investment brokers and investment bankers that come together. And you've got what's called the financial supermarket. And this concept got really big in the 90s. And it's still with us today, where one company offers everything. And the goal is the theory is, each customer, whether it's an individual or business, has a variety of needs. So why would you sell one thing? Why would you spend your capital establishing a relationship with that individual and then only have one product to sell that person? So it's called pocket share. You want to sell as many different services to that person as you can once you get the relationship going. Okay? And so this was kind of the case before the Depression. We had some really bad incentives that came into being, just like we had with the financial crisis. And these industries were separated out to protect consumers and to protect the economy from greedy business people. Okay? But these regulations have broken down over the last really 30 years, which led to the financial crisis. So we have to hope that we figured out how to allow these things to happen without significantly increasing the risk of another financial crisis. I think that's it, yeah. All right.